Hey everyone, welcome back. So today we're going to dive into the Dupont Analysis, which happens to also be one of my favorite tools to use when I'm evaluating a business. So the Dupont Analysis is a financial tool that was actually created by a Dupont employee back like in the 1900s or something like that, a guy named Donaldson Brown. And he actually created this equation to evaluate how efficiently DuPont was actually performing in its underlying economics in comparison to to peers in the industry. So he created this equation, and it's been used ever since. And it's a really, really great tool for looking into how a company's return on equity is actually generated. So in the simplest form of the calculation, you can simply just take the net income and divide it by the average shareholder equity, and that will produce a return on equity value. But it doesn't take into account the other components that may be affecting that value. So the Dupont equation dives a little deeper into that. So as an investor, for myself, there's a few questions that I ask, right? Of course, when I'm trying to value a business and see if I want to put my hard-earned money into it. So a couple questions that I ask are, is the company leveraged up to its ears? Like how much debt does this company have? Secondly, it's where is the bulk of the profit being generated from? And then is the company actually utilizing their assets in an efficient manner to generate revenue without having to keep on putting in capital or keep on issuing bonds or debt to the public? So those are just a couple of the questions that I like to ask. And so the DuPont analysis actually takes those components and answers those questions. So the DuPont equation looks something like this. And it's built up of these three separate calculations that are multiplied together, and they're all basically just financial ratios. So the first financial ratio is the profit margin. The second one is a ratio describing the asset turnover, which is basically how efficiently the organization utilizes its assets. And the third is its financial leverage. So it takes into account how much leverage the company has in order to continue its business operations. So for myself, I like to see that the financial leverage ratio is not overly high. In most cases, it will probably be the higher of the three. Not in every case, but in a lot of cases, you'll notice that it's the higher of the three, but it's not necessarily a bad thing. An organization taking on debt doesn't always indicate problems or underlying economic issues in the business. But what can happen is that if management doesn't know how to efficiently utilize that debt and produce more profit than what it's paying in interest in order to have that debt, then it's not really an efficient piece of the business, and it could actually be a burden on the business as well. So when I make my DuPont analysis, I really like to hone in on that. Secondly, I also like to actually take all my data, which I'll show you while I'm doing the Excel sheet as well. I like to take my data and I like to put it into a visual format. And the visual format allows me to actually see the trend of the underlying economics of the business. So I'll go into that when I'm doing the Excel sheet. And yeah, let's just jump right into it. Should be pretty straightforward, pretty simple. Feel free to pause the video and just copy what I have on my Excel sheet before we get started. And yeah, just follow along. I hope you enjoy. Okay, so here we are in our Excel sheet. And as you can see, it really is just a super simple setup. So all we got is our date range up on the top. And we've got the parameters that we're going to need in order to calculate the return on equity. So that's revenue, net income, total assets, shareholder equity, and the Ebit. So just to save some time, I'm going to copy and paste some data. So all of the revenues and all of the other data set is from a company that I'm currently doing some due diligence on called Accenture. And we'll go ahead and calculate the return on equity for them. So ROE, or return on equity, is going to be equal to the net income divided by the revenue, which is the profit margin, multiplied by the revenue divided by the assets, which is the asset turnover ratio, multiplied by the assets divided by shareholder equity. And that's going to give us a percentage. And we'll go ahead and just in the bottom right-hand corner here, grab that little box, drag it across, and it's going to calculate the return on equity for the remaining years in our data set. So right off the bat, I can see that, wow, this company has got a fantastic history of return on equity. We got 50, 54, 39, 39, 33, 30, 30, so on. So over the last 7 years, this company has averaged 39% return on equity, which is really phenomenal. I think the average return on equity for any corporation in the US or Canada is maybe 12% or something like that. So really to average 39% over the past 7 to 10 years really is a phenomenal job by management. But here's the thing that I had come to realize. The return on equity can go a lot deeper than simply just this value. So there's 3 components that make up the return on equity from the Dupont analysis. That's profit margin, asset turnover, and leverage. Now, depending on how much weight these individual components carry in the equation, dictates the results that come out the other end. So let me show you what I mean. So we have our ROE, and that's equal to profit, asset turn, and leverage. So if we have our profit margin, which is equal to the net income divided by the revenue. The asset turn is equal to the revenue divided by the total assets. And the leverage is equal to the assets divided by the shareholder equity. Just go ahead and turn that into a percentage. So as you can see here, the leverage and the asset turnover really carry the most weight in this equation, right? So if you're multiplying all 3 of these together, these really high values right here are going to heavily skew the equation. So that prompts me as an investor to dive deeper. Well, okay, where are these numbers coming from, right? So the one thing I had found about myself in particular is that I really like visual aids. And for somebody who's new into the investing world and financial statements, and even for maybe some more experienced people, they've probably come into the realization that sometimes numbers, well, they're kind of boring and they're dry to look at. So sometimes it's hard to deduce what it is they're actually trying to tell you, right? Looking at this return on equity, you're like, oh yeah, that's a great number, but what does it really mean in terms of the underlying economics of the business, right? So I started putting all my data sets into chart form, and it really has helped me out with visualizing what the underlying economics of the company looks like. So go ahead, highlight the column on the left-hand side, and highlight all the data as a separate piece. And go ahead into Insert and go to Recommended Charts. Go for the line chart, and that's going to populate and put all the data into a nice table, or into a nice chart for you. Then what we can do is click on the chart, go to the bottom icon, click it, under Categories, deselect all, and then go to the bottom right corner and click Select Data. You're going to have this window pop up. Now, in the box that says Horizontal Category Axis Labels, go ahead and click Edit. And then what you're going to do is you're going to highlight all of your dates up at the top of the screen. And you're going to click OK and OK again. And what that's going to do for you is that's going to populate your x-axis with all of the corresponding dates for each set of data. Now, we have our nice looking chart. Where do we go from here? So immediately what I am noticing in this chart is the steady increase in revenue and the steady increase in total assets, as well as the steady increase in shareholder equity. So what this tells me is that, sorry, actually, let me go back. So each line is represented by a separate color. So the revenue is the dark blue, the assets is the gray, the shareholder equity is the yellow, the baby blue is your EBIT, and the orange is your net income. So what I'm seeing here is that over the years, the company has steadily been increasing its asset base, and more so and at a more rapid pace within the last 4 or 5 years or so. But the more important piece to that information is the gap in between the assets and the revenue, and also the slope of the revenue line. So what I'm seeing is that every year, as the company increased its assets, its revenue was also growing at a similar pace. So what that tells me is that the company has been really efficiently utilizing its assets to generate more and more revenue. If the company was continuously buying assets and not generating any more money, the line would either be flat or declining. So to bolster that conclusion, if we also go up to one of our components of the ROE equation, the asset turnover, we can see that asset turnover ratio is at 181%, which means that for every dollar the company spends on an asset, it makes $1.80 back, or almost doubles its money, which is fantastic. Next, if we go down to the shareholder equity, we can see that the shareholder equity has been similarly following the same trend. It's been steadily increasing over the years, with a little bit of an increase in pace over the last 4 or 5 years or so. But it also follows in line with the increase in revenue, which means that the company is also super efficient at utilizing its shareholder money to generate revenue. So just from those 3 lines, what I can see is that this company in particular is super efficient at utilizing its assets to generate income. It's also very efficient at utilizing its shareholder equity or its shareholders' investment to generate revenue as well, which is great. You want to see that in a company, that the management is utilizing your money efficiently. Next up, we've got the EBIT and the net income. So for myself, I mean, there's not really too much to conclude here, but there is some information that you can take away from these 2 lines. One of them being the fact that each of these 2 lines is so close together. So what that's telling me right off the bat is that this company most likely has a really minimal amount of debt. So let me show you what I mean. So EBIT is your earnings before interest and taxes. So the taxes component of that is inevitable. Every company needs to pay taxes, and it'll forever be a piece of the profit margin that has to be given up. But the interest is the interest that companies pay on their loans or their debts, right? So it's interest paid on debts. What a low interest payment ratio means is that the company most likely doesn't have very much debt. So let's go ahead and just take a peek at that. So if we go 4.49, that's our EBIT. And let's assume a 30% corporate tax rate. So let's go 30%. That leaves us at 3.45 billion. Okay, after taxes. But now we still need to account for our interest rate, right? So after taxes and after interest. So what this means is that our net income is 3.05. Not as a percentage, that is my fault. Give me 1 second, 3.05. Okay, so if we look at the difference between this and this, we have, I don't want that as a percentage either, we have 0.4. So what that means is that out of $3 billion, out of $4.49 billion in EBIT, the company is only spending about $400 million in interest, which means in a $400 million interest payment, the company was able to generate $33 billion in revenue. So what that tells me is that the company doesn't really rely on debt in order to generate its money. So automatically that gets me really excited, because that means that this company has a sustainable enough operation that it doesn't need to be taking out bank loans and borrowing money from other companies or other people in order to continue its operations and increase its revenue, which is fantastic. So that is one other thing that I can tell from this line, which is a super important piece. All right, so I hope you enjoyed that video, and I hope the Dupont analysis will help you along your investing journey. There's one thing I did actually want to touch base on, and that is the financial leverage ratio. So in the beginning of the video, I had mentioned that it might end up being the higher of the three, and that's not necessarily a bad thing. And let me just touch base on why. So for this particular organization, being in the infotech sector, I believe, a financial leverage ratio of somewhere between 2 and 3 is not necessarily a scary thing. So for instance, if you were to do the Dupont analysis on a banking organization, you would notice that the financial leverage ratio is somewhere upwards of 8 to maybe 12, right? Or so in other words, 800% to 1200%. So it's not necessarily a bad thing. If you were to look at an organization that might be in the automotive industry or in the heavy equipment manufacturing industry, you would notice that that financial leverage ratio is a lot higher in like the 5 to 7 range or something like that. And that's because these organizations operate on different business models, right? So Infotech might have really, really low overhead and doesn't really need to take on a lot of debt in order to maintain its operations. But something like a heavy equipment manufacturer needs to buy plants, property, machinery, tooling devices, huge pieces of equipment, right? So they have to take on sometimes a lot more debt. It doesn't necessarily mean it's a bad company, but it's something you have to keep in mind when you're investing in certain companies within specific niches or business models. So anyways, I just wanted to touch base on that and let you guys know that it can vary, and really take it with a grain of salt. Don't necessarily take the financial leverage ratio at face value, being like, oh my God, 300%, like, wow, that's freaking insane. It's not actually. It's relative to the industry that the organization is operating in. So while you're doing that, just take note of that, because that is essentially what the Dupont analysis was initially designed for, was to analyze a company's internal operating efficiency relative to its peers in the same industry. So keep that in mind. And like I said, I hope this helps you out on your investing journey. If you enjoyed the video, please like and subscribe. Feel free to leave comments, whatever you guys like. Anyways, I will catch you next time.